Welcome back to Crown's Crypto Cave and another skill video today as we get deep and down and dirty into it, especially with our lovely community members making all of the indicators that make this such a breeze. So with that said, today we're going to be talking about simple moving average crosses and also presenting the anticipated simple moving average cross indicator made by our lovely caretaker. Now, of course, you can find that indicator in the description of this video right here if you just want to fast forward and just get it immediately. But with that said, we're going to start it off with, first off, where to get. So the two tools that we're going to be using today are simple moving averages. And for this, I would just type in here on the, the public library. Whoops. Also need to know how to spell as well, but simple moving averages would be the correct terminology. There we go. Hey, come on. Let's see. There it is. Lovely. And I've actually gone ahead and picked out this one by Joe Musk. It's really not going to matter which one that you go after. They're pretty much all the same. Just we want something that allows us to manipulate the different inputs. So this one right here, I can verify good for that purpose. And I already have it on my chart right here, which will bring up right to there. And I have made it so that there's only two moving averages visible right now. And then you can go into the settings right here and change them all up. Then we want to bring up, of course, the anticipated simple moving average crosses. Oh, there it is. You just have to type it like that. But there you go. It's by Mr. Caretaker. I'm actually going to favorite it right now. And like I said, there's going to be a link in the description of this video to this indicator right here. And I'll bring it up in the bottom pane right here. And here's how it should look. Anyways, with that said, we want to first focus on the meat and potatoes of this video here with just the simple moving averages. So with that said, settings. Well, let's go into the nice cogwheel right here. And as you can see, you do have several different moving averages if you want to put them on there. I'm only going to do this demonstration with two of them as it is right now, but we'll go over some very simple settings here. Everyone kind of has their own, I suppose, like a potion, if you will. And very common settings are going to be a 7, a 20, a 30, 50, 100, 200, stuff like that. Also, Fibonacci numbers pretty damn popular as well, as they do correlate with a lot of algo-driven targets, and those are actually relatively similar as well. I believe 5, 8, 13, 21, 34, 55, 89, 144, and 2 something or other else. Anyways, you're more than welcome to do that yourself. However, we're just going to be focusing on some very, very remedial and easy strategies to apply here, and then use the anticipated simple moving average cross to denote some easier ways to generate more edge on this. So with that said, we're going to start it off first and foremost with just a very simple 50 and 100 moving average right here. And I want to show you something just incredibly simple. This is not anything too crazy. This is, general knowledge, and it's something that you can apply and probably understand just like that. And that is this, the 50 and 100. So I'm using the cyan blue as the 50 and the white as the 100. And the general rule is that when price action is between these two moving averages, the underlying asset is going through a period of consolidation and then will resolve itself with an emerging trend when you see the next cross of price action amongst those. So in this case right here, we want to be using the shorter period moving average, in this case the 50, to kind of judge where we are in the current trend. And then also the 100 is like the signal line for that, essentially, if you're kind of thinking in other terms. So how would this work out? Well, as you can see right here, maybe we should actually even just go to like a 4-hour time frame, perhaps, as it's going to make a little more sense here. And we need to go back to a more dynamic time in Bitcoin price action. And as you can see right here, anytime that price action is between these two moving averages, Bitcoin's essentially going sideways within a range, and anytime that we do see a crossover of these alongside price action, that is when we do see trending moves emerge. And perhaps it might even be better to go to a higher term time frame here as well, just so that we can get this a little bit better. And there we go. So why is this useful, or how is this useful? Well, it lets us know when trend is on, which potentially could mean to put risk on. Of course, this is not financial advice. I'm not a financial advisor. And also lets us know when things are going into a decision phase, aka consolidation, where we could see a reversal, or just might be time to take some positions off. So in this case right here, we do see that we get a bullish cross with price action above. And what happens after that? A lovely move from about 6,900 all the way to about 10,000 bucks. And you know that because we see price action remaining above both both these moving averages as they have positive slopes, and voila, there you go. Now, once Bitcoin comes back down below the 50, meaning that it is now currently living between the 50 and the 100, we can look at this as a consolidation range emerging. Yes, things do pop up once again above that level, and that's completely fine. It actually does let you know to kind of put risk back on right in this region right over here. However, as you can see, over time, things do get smoothed out, and we go into a greater consolidation phase. Now, with that said, as you can see right in front of your very face, is this like 100% guaranteed way to be trading? No, there's going to be a lot of fake outs here and there. However, the same sort of knowledge that we applied to the MACD applies here as well. If we just look at the crosses that happen on the same side of the current trend for that time frame, your results will be infinitely better than just trying to play every last little thing. And with these two moving averages right here, we get an insight onto when is the most likely time, or sorry, when things are going into a potential reversal, or just we're not really in the same trending momentum anymore. Okay, all right, so these are two, very, very simple ones that you can apply right now. And as you can see, anytime that price action gets caught between them two, that's when we're kind of in a decision phase. Same thing right here, same thing right here, same thing right here, same thing in this segment right here, and so on and so forth. And as we denoted before, when we are looking at the current trend within the context of this, we can just eliminate the counter trend signals. So what does that mean? In the context of this uptrend right here, that goes into a sideways consolidation, we just ignore the bearish cross unless if we actually get a full-on reversal, meaning lower lows and lower highs in this case. In this case right here, that's not what we get. We see that a nice support level of about 8,900 is held, and no reversal of trend, so we just ignore the signal right here. And then what happens a little bit later? We actually do get a bullish signal. Now, is it the most perfect timer of an entry? No, but you don't need to be. The point is we want to just capture these short-term moves so that we can, well, make an edge out of it. And of course, like I said, this is this is a very remedial way of trading. But even with these very simple tools, still pretty damn effective. Same thing over here. We get a bearish cross, but has the trend changed? No, not really. Then things come back in the middle right here, kind of lets you know, hey, we're going into a decision phase once again. Pay attention, and what do you know? Trend continues to the upside. We get the bullish cross right here, and I mean, this one's kind of an unfair example, but just goes onwards and upwards to the infinity and beyond. Anyways, this of course will work with just about any asset. I mean, this is knowledge that I learned in traditional markets, anyways, and it applies pretty much everywhere that I've looked. I'll just bring up another random chart, perhaps. Maybe we could go and check out. Let's go check out SPY actually. Where's my SPY? SPY, where are you, sir? I guess we can just look at futures instead. These are SPY futures. And as you can see right here, when you get the bullish cross and when price action is above and they both have positive slopes, boom, there's your emerging trend. Looks good. Anytime that it gets caught between the two moving averages, that's your sort of warning signal. Hey, maybe take a little bit of risk off, or maybe just be cognizant of the fact that we might actually be in the midst of a reversal. But as you can see, when they both retain positive slopes right here, is there any real threat of that? Not really. In fact, the 100 simple just becomes a little bit more of an opportunity, perhaps, for that emerging trend. Same thing over here, gets caught between the two and then actually loses the 100. That, again, is not an actionable signal. It just lets us know that, hey, what's going on right here is we are going through a consolidation, and what happens after that? Well, Bitcoin, SPY kind of figures itself out, and we actually do get a bearish cross right here, which in the context of this one, to be fair, actually would have been. Well, no, they both don't have negative slopes, but it would have been a good insight that, hey, this is not the time to be having risk on. You're looking for a signal, more like what we saw back and over here. Okay, all right. So that is the general rule. Again, there's a million different ways to play these, but like I said, very common inputs for simple moving averages can be 7, 10, 20, 30, 50, 100, and 200. It's kind of like 7 days a week, 30 days in a month. So on and so forth. 100 obviously doesn't really make as much sense, but it's a nice round even number, so a lot of people got it on their radar as well. Okay, so very simple stuff right there, and you can play around with these. A few other crosses that you might find interesting is a 10 and a 21, pretty well, pretty well-known stuff, I suppose. But this one actually is pretty damn good for the daily trend. In fact, if you just want like a little bit of a general trender here, we'll call it, anytime again that we see a bullish cross on this on the same side of the current trend, those are your good moves. And this one, it's not gonna be perfect. Of course, it's not gonna be perfect, but when you do get those trending signals, you can even, I mean, even if you did blindly trade this one right here, it still works out in your favor over time. It's just probably not optimal, we'll call it, but that's that's besides the point right now. We're just looking for sources of edge. That's all. Okay, cool. So another very quick one right here is going to be the, let's just talk about like a short-term trend. We could use a 7 and a 30. Pretty damn simple stuff as well. There we go. My keyboard's a little bit further away from me right now. But looking at this one right here, this one's going to speak a little more towards your short-term trend. The 50 and 100 strategy that I just kind of postulated, that's more for like kind of dividing your chart into 3 segments and then judging trend versus consolidation versus reversal. This one right here is more so just, short-term trend. And then of course the classic one, everyone knows about this one, and for good reason. I mean, it does hold up quite well, and that is the golden cross right here. Sometimes I use a 55 rather than a 50. It's going to be about the same anyways, but the moving average, the inputs for the golden cross are the 50 and 200. This one speaks more towards long-term trends. So 7 and 30, short-term trend, 50 and 200, long-term trend, 50 and 100, different strategy altogether. We're just kind of looking at, as we spoke about before, reversal consolidations and breakouts. But this one right here, as you can see, signals don't happen very often. Signals happen actually very sparingly, in fact. And is it perfect once again? No, it's not perfect, because if anything is, if anything is perfect, everyone would use it, and that would just be it. But as you can see, if you generally follow the signals over time, it's going to be profitable, and it does let you know the general feeling of that asset from a long-term trend perspective. Same kind of knowledge applies here as well. Okay, all right. Let's talk about one simple trick. One simple trick. It's like the fucking what's it called? Clickbait title that you could do. But one simple trick that you could use to make any cross, any sort of cross more efficacious, and that is this. You're looking for a very specific signal, which I'll try to find an example of as best as possible. Maybe we need to go to a different time frame here. Maybe like a 4-hour would be good. Or actually, we could just go with those other inputs, because I do believe that we saw one earlier. Just do the 50 and 100. There we go. All right. Actually, you know what? Let's use a short-term trending one. Let's use 7 and 30. Whoops, wrong number. Okay, there we go. All right, sweet one. Okay. So there's a very specific signal that you're looking for on crosses that are more likely to be good. We kind of already alluded to a couple of those of those narratives. First and foremost, we want to trade on the same side of the current trend for that time frame. That alone is going to make your results much better. On top of that, we also want to see slope analysis of those moving averages on the same side. That's also going to increase your efficacy as well. The next one is really important. If you can get all these 3 things together, these are the usually big trades that I really like to see. And that is this. We're looking for a cross where price action is pulled into the cross and then buoyed up in the same side of the cross. So for example, we see, let's see, do we get a little bit of a fake out right here? Yeah, we got a little bit of a fake out right here. Actually, you know what? Let's go like for a full on one. Here's a good one. Okay. So first off, let's identify the trend. The trend is very obviously to the upside, quite nice. And what do we see right here? We do see a bearish cross, but because it's against the trend, ignore. Fuck that one. That one can go kill itself. Just kidding. Don't kill yourself. I'm not encouraging suicide. I was just a bad attempt at humor. Anyways, looking at the one that happens right after that on the same side of the trend, we see that 1, same side of the trend, 2, both moving averages with positive slopes, and 3, and this is the big point right here, we want to see price action pulled into the cross and then spit back out. And that's exactly what you see right here. Price action is pulled into the cross and then boom, nice move to the upside. And this is deceptively not as impressive, because that is, well, that's about a $1,200 move. Bitcoin's magical now, isn't it? Let's go for another example. I want to find like a really good picture perfect one. This one over here, pretty damn good. trend to the upside. We see both moving averages with positive slope. The 50 obviously is going to be a lot the 7 is going to be a lot faster than this one. The 30 is, being flat is fine. Being flat on the 30 on the slower moving one is completely fine, but you want certainly the faster one to be on the same side as far as slope goes. If they both on the same side, even better. But just really needs the faster one in this case. And what do you know? Price action pulled into here, buoyed back up, and trend emerges. Same thing back on over here. A little bit of a fake out. Yes, this one is against the current trend, so we ignore. This one is on the same side of the current trend, so we take. And they both have positive slopes. Great. Gets, this one actually a little bit less pulled into it. This one just bulldozes its way through. But the consolidation around these two levels is good. It's a good sign. Anyways, okay. Let's find here's a good one for the other side. Actually, do we want to take that one or do we want to take another one? No, there's got to be okay, we need to get before coronavirus dump times. Yeah, there we go. All right. 4 hour trend is down. Trend is down from this area right here on the highs from about 10,500, and trend emerges right here. And then all of the bearish signals that we get are pretty damn good, except for this one right here. It's not gonna be perfect. Again, if it was perfect, everyone would fucking do it. Takes a little bit of it. That, that's why I do say that technical analysis is more or less an art rather than a science, because otherwise everyone would just put this on their fucking bot algos and we'd all be rich. It's just not the case. Trend is to the downside right here, so we ignore this bullish signal right here, and then we take this bearish signal right here, and this one's perfect. It gets sucked up into the cross, spits back out, and then boom, there's your nice trending move. This is what you're looking for. Okay, so that brings me to my next point. Defining your exits. I despise. Okay, first off, what everyone gets wrong about moving average crosses is what we already kind of defined. But what really fucking ticks me off when people say moving average crosses don't work. It's like, okay, first off, that's silly. But second off, more importantly, the reason why they a lot of the time don't look or don't perform as well as you would expect is because people both use the simple moving average cross for both the entry and the exit. While I do think that it's pretty damn good at getting the entry, what it's terrible at is getting the exit. So with that in mind, I would strongly suggest that if you are going to use this as a potential source of edge, you do not wait for a cross on the other side to denote your exit. It's just not optimal, and I don't really see a real reason to be doing that. And there's people all across the lands who do tests on these things, and they do it that way, and it fucking pisses me off because it's like, hey, if you're gonna argue against something, at least give that something. It's like its best case scenario, because then you're gonna be arguing against, the best case scenario, not just like a very doctored area, which is just irrelevant. It's intellectually dishonest in my opinion. So let's see. How do I want to explain this? Okay, so many ways to do this for the exit. Obviously, horizontal resistances are always going to be relevant. So let's say that we just mark off this area right here, and we take the bullish trade right here. I mean, this one's perfect, right? As pops back above, positive slope on the 7, although the 30 actually a little bit lagging right there, pulled back into it as well. So that is, potential entry right there, boom. And then we say, hey, our prior highs was in this region right here. We definitely want to be getting out some right there. In fact, I'd even suggest that this area right here too, as a nice horizontal, would have been a good target point 1, and both of them get hit. And technically speaking, it actually, if you were using crossing on the other side, you would have gotten out right here, to be fair, and that would have been actually smack dab in the middle, so it would have actually averaged out, of course. But a lot of examples where this is just not going to be the case, and actually does incur a lot of unnecessary leftover profits. So the other way that I do this, which is in my opinion a better way, is to bring up some sort of a momentum oscillator. In this case, I'm going to use the RSI, so a very basic tool right here. And what I want to be looking at is divergences. The reason why is because with divergence plays, what are we measuring? We're measuring a loss of momentum. And what are moving averages doing? They're telling us about trending plays, but we want to know when that trending play is losing its momentum, so that it potentially is, a good time to be letting go of some of our position. Actually, I want to get rid of this right now. We don't want to focus on that just yet. Don't want to spoil a surprise. That's the fun part now, isn't it? But yes, let's say we take the signal right here, and then things continue upwards and onwards. We get a high right here, and then we start to get divergence within this region right here. Actually, even puts in a bit of a head and shoulders on the 4-hour RSI. Let's go over a better example. Perhaps right around here. Yeah, this one's actually a great one. Okay, so we get the bullish cross right here, get sucked up into it, spit back out. Beautiful. All right, then what do we have? We have a very slight amount of divergence on this level right here. That would be, sorry, let me just mark it off. Boom, something like this. And then, well, it's more like this, sorry. Very, 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 very slight, but yes, it is indeed there. And that would have been a better exit than, say, waiting for this this bearish cross right here. By the same token, we get yet a, nope, let's, actually, we don't have an example right there. Here we go, here's another good one. All right. So let's say we take this signal right here. Again, we get the bullish signal. We get positive slopes on both, sucked into it, spit back out. Lovely. And then what happens after that? Trend emerges to the upside, but we start losing momentum in this area right here. Here's your high, here's your next high, here's your third high. 1, 2, 3 strikes, big bearish divergence, 1, 2, 3, and 1, 2, 3 typically is like that, 3 strikes and you're out. If you can just remember that, that small phrase. Yes, 2 strikes, does typically produce a little bit of a pullback. 3 strikes can produce a bit of a reversal sometimes. And in this case right here, that tells you to get out at this level right here. And then if you really want to get crazy with it, we actually have 4 strikes in this one, which would have told you to get out this one right here. So let's say, you let some of your position go right here as things do come back down, maybe even reload along the 30. Could be, fair enough. In fact, that, I won't get into that sort of strategy with position management on this video because it's just gonna be too fucking long, but you can probably figure that one out yourself. And then what happens soon after that? We get another high right here, but significantly lower highs on our momentum oscillator, which suggests what? Big loss of momentum, and then boom, down we come. So this would have been a good place to kind of take profits at. And then you actually get another bullish signal right here. So you could have re-entered the trade and you could trade all of these, all these areas right here. And you even notice another drive of divergence here on this higher high with another lower high in price action. So if you did take this signal right here, assuming that you got out right here, you're just kind of riding all of the waves on this one. And there you go. Get out once again. Lovely. Anyways, okay, let's get off that. Let's get rid of this RSI right here. Let's talk about the reverse function of this. So credit to Caretaker for making this one. Obviously, this is a idea that was first postulated by, I believe, Dimitri Sizakis, or he sounds Greek, so I don't know how to say his name. It's certainly in the description of this indicator. I don't want to make it sound like Caretaker was the first one to make this up. It's just he's made it available for everyone freely on what's it called, on TradingView, and I believe it's open source code as well. In fact, I can confirm it's open source code, so you can make use out of it yourself. Anyways, what I've done down here is I put on the same moving averages. So this is a reverse function down here, meaning that it tells us the price point at what would be needed to actually cross these moving averages 1 bar in advance, which is really, 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 really useful. As you can probably already guess, why? Because it tells you to anticipate something that says, hey, warning, warning, warning. We have a potential signal in progress right now. Get ready. Check all those 3 major things that denote whether an entry is warranted. Again, we want to see a trend on the same side as the signal. That's number 1. Number 2, we want to see at least the lower period moving average on this with the slope on the same side of that signal, and the slower moving average at the very least sideways. Can it be on the opposite side sometimes and it will work out? Yes, but those are going to be less efficacious over time. If it's at least sideways, and especially if it's on the same side as the trend as far as slope analysis goes, good. And then the third one, obviously we want to see it pulled back in and then spit back out. If you can get all of those 3 and this condition is flashing, boom, that's it. Now, on the other side, risk management. This is also incredibly useful for risk management because why? Well, it tells you when things are going to cross to the other side as well. So it tells you, hey, warning, warning, warning. You might want to consider getting out if things are going to cross on the other side. Now, like I postulated earlier, I don't think that that's the most optimal way of doing things. I think that this is better timer for entries rather than exits, but that is once again available for you. Now, is this perfect down here? It's actually not. We've gone through a study on it, and it actually does. It will front run it improperly about 2% of the time, but 2% of the time is, well, that's good enough. That's good enough by my standards, man, that means 98% efficacious, or sorry, efficaciousness, or effectiveness. Good enough for me. Anyways, as you can see right here, it's telling you that we're about to get it's saying a warning signal, actually literally exactly where we're at right now with the 4 hour. The 4 hour 7 simple does have a positive slope. We're being pulled into the cross. The 30 is, to be fair, a little bit more tilted towards the downside than it is sideways, but it's potentially there. And it lets us know that, again, 1 to 2 bars beforehand. So you can imagine that if you did want to front run the signal, this would be a really, really good indicator to do that, to give you a slightly better entry. And then also you can manage your risk on the other side. So it works both ways, which is incredibly useful. So with that in mind, it would be saying, hey, maybe consider entering right here. And if we're just targeting horizontals, I'd probably target right here, like 19,550 or something like that. However, it is a bit of a weekend right now, so how much do I believe that's going to play out? Fair enough. But yes, that is going to help with getting or generating slightly better entries. Let's see, is there any other good ones over here? Let's say that we took this bearish signal right here, and we knew that because, well, it's telling us, hey, we have a bearish signal impending, boom. And then down here, it tells us about the loss of momentum on this one, as we do get a bullish signal, and it tells you about 1 or 2 bars beforehand. In fact, in this case, it actually tells you 2 bars beforehand. So it says, hey, stop fucking around in this region, time to get out. If you are using this as your exit, which, as we postulated earlier, not the best way, but again, gives you a further warning signal to kind of check and verify yourself, which I really do like. Okay, all right. Want to make sure that I hit everything over here. I believe that I have. This is a 26-minute long video, and like I said, this is a very remedial way to be using simple moving averages, but as you can see, quite effective, if you do actually know how to use them properly. And with that said, I'd like to wish you the best of the best. See you in the next one. Take care.